After studying this module, you shall be able to know about mergers and identify the types of mergers. Learn about theories of mergers that provide motive for mergers. Analyze and identify the determinants of success and failure of mergers. The term mergers and acquisitions are often used interchangeably. However, there is a difference between the two terms. Merger is said to have occurred when two firms come together to form a new company under common ownership. Here, the less important firm of the two completely loses its identity and corporate existence and becomes part of the more important of the two firms. The firm that survives takes up all the rights, liabilities, and privileges of the merged entity. Whereas acquisition is said to have occurred when one firm buys or acquires assets of another. Here, both the firm continues to exist. As in case of mergers, acquisitions do not require the acquired firm to surrender its stocks. Trading of the stocks of the firm bought prior to acquisition continues even after the acquisition. Following acquisition, though there is change in the management, both the acquirers, one who acquires or buys, and the target, that is the firm that is acquired, maintain their separate legal identity. Mergers are mainly of three types. These are: number one, horizontal merger. Horizontal merger refers to consolidation of two different firms operating in the same area of business or market into a single company. This would result in the increased market share of the new single company coming into existence due to merger. The main purpose of this type of merger is to acquire market power. In addition, such mergers also result in reduction of competition and cost, an increase in share prices and market segment. Some of the examples of horizontal mergers include the recent merger of Vyas Bank with Kotak Mahindra Bank, Myntra with Flipkart. Horizontal merger raises three major issues related competitiveness. Such arrangement eliminates the competition between the merging firms, which may be of significance depending on the size of the firms. Merging results in creation of substantial market power. This would enable them to manipulate the price by altering production unilaterally. Finally, increase in concentration in the market would enable strengthening of the transaction such that other participants of the market will be able to coordinate their pricing and output.
Second is vertical merger. Vertical merger refers to consolidation of two different firms operating at different stages of production process of the same product. The merging firms are involved in different stages of production and distribution of that product. The aim of such merger is to increase profitability based on the direction of merger. Vertical mergers are of two types: backward mergers and forward mergers. When the firm merges with its supplier, it is called as backward merger, and when it merges with its customer, it is known as forward merger. The main benefit of vertical merger lies in internalization of all transactions between different stages of production and distribution. This internalization provides better and a convenient way of monitoring and improving performance. Vertical merger is considered anti-competitive as the market power acquired by the firm due to mergers prevents entry of new business into market. Decision of the acquired firm to deal only with the acquiring firm alters competition among the suppliers or customers. Vertical merger leads to suppliers losing market for their goods. Retailers may have restricted supplies. Thus, vertical merger may deprive competitors from the access to supply or to customers. Third is Conglomerate merger. Conglomerate merger refers to consolidation of two different firms producing unrelated or independent product and operating in different areas of business market into a single company. Such mergers result in formation of large diversified firms. This does not raise concerns about market dominance. However, their ability to cross-subsidize raises serious concern about unfair competitions with undiversified competitors. Conglomerate merger helps firm to reduce the capital and overhead costs. Moving on to theories of merger, starting with the efficiency theory. The efficiency theory is considered as one of the main motive for mergers. The net gain from the synergies act as the major benefit that drives merger. Synergy refers to a concept that greater shareholder value will be created when two or more businesses are in combination rather than when they operate separately. It may be measured as the excess of the cash flow received when operating in combination than achieved when they are separate. These synergies are mainly of two types, that is, operating and financial synergy. First, efficiency theory is the operating synergy, which is related with economies of scale and scope. Operating synergy comprises both economies of scale and economies of scope. Both these components of synergy act as important determinant of shareholder wealth creation. Efficiency gain can be derived from either component of synergy or from improved managerial practices. Economies of scale are realized by spreading fixed costs over increasing production levels. Here, scale is defined by fixed costs such as depreciation of equipment and amortization of capitalized software, normal maintenance spending, fulfillment of obligations such as lease payments, interest expense, taxes, long-term union, customer and vendor contracts. Utilization of set of skills or an asset specific to production of a given product or service to produce another product leads to economies of scope. This happens mostly when it is more cost effective to carry out production of multiple products in one firm than producing them in separate firms. There are several examples of economies of scope when the firm uses a set of skill or assets to produce or sell multiple products, like Procter & Gamble, known for its consumer products, effectively uses its highly regarded marketing skills for consumer products to sell both of personal care as well as pharmaceutical products. Honda has the expertise in enhancing internal combustion engines, so apart from car, it also manufactures products that uses internal combustion engines like motorcycle, snow blowers, and lawn mowers. Second is financial synergies. Financial synergy deals with the impact that a merger has on the cost of capital of newly formed firm resulting from the merger. The minimum return required to motivate the investors and lenders to buy a firm's stock or lend to the firm is known as cost of capital. Theoretically, this cost of capital could be reduced under conditions such as non-movement of cash flows for the merged firms, realization of financial economies of scale from transaction costs. Lower cost of borrowing would also result when a firm that has excess cash flows combines with a firm that has internally generated cash flows insufficient to fund its investment opportunities in a mature industry. Firms with low growth may produce cash flows in excess than the Available investment opportunities. Another firm with high growth may lack enough cash required for the available investment opportunities. Thus, firms in a mature industry may have a lower cost of capital than the one in high growth industry, and combining such firms could lower the average cost of capital of the merged firm. Third efficiency theory is profit and efficiency, which we will study with help of the figure. Figure 1 shows that horizontal merger is based on higher unit revenues from the use of market power and lower unit cost from efficiency savings. If two firms having identical cost curves, AC1 and AC2, which include normal profit, then these two cost curves are drawn such that OQ1 is equal to Q1 Q2, and the average cost of AC2 is drawn with reference to a vertical axis rising from point Q1, so that both cost curves are identical. Both the firm would supply the same quantity under the assumption that the nature of oligopolistic competition has enabled the firms to meet the given demand DD1 at a price that just cover the average cost and also allows them to earn normal profit. Thus, both firms operate at the minimum average cost at price OP1, with firm 1 supplying OQ1 and firm 2 supplying Q1 Q2. In case the merger of the two firms, the resulting combined firm will have the option of using its market power to restrict output and raise prices. In case the prices were increased from OP1 to OP3, then output would be reduced to OQ3. Consequently, the merged firm will be left with excess capacity, and in the short run, it could produce this output using only on production unit at an average cost of OC. The second unit will be left idle, but the fixed cost of second unit will still incur. However, in the long run, the correction measures taken by the merged firm by rationalization of production and other functions could result in achievement of average cost curve AC3, which would enable the merged firm to produce at a lower average cost and charge higher prices. After the efficiency theory, next is diversification. Company buying a firm which does not belong to its existing line of business is termed as diversification. This results in financial synergy, which reduces the cost of capital. It may also enable a firm to shift to the production of such products, related or unrelated, having higher growth potential. The extent to which the diversification is unrelated serves as a measure to gauge the effectiveness of management in running the combined firm resulting from merger. Firm can accelerate growth through related diversification by selling its product in a somewhat unfamiliar new market, which may be risky. They can also achieve higher growth by selling new or unrelated products in a familiar and less risky current market. This is considered to be far less risky. This unrelated diversification does not provide any benefits to the investors. They consider companies that diversify in unrelated areas are much more risky, as the management faces difficulty in understanding the process and often fail to decide correctly on most favorable investment opportunities. The investors are further faced with challenges in understanding and valuing different parts of a diversified business. Next is strategic realignment. The strategic realignment theory considers mergers as a way the firm make rapid adjustments to the stimulus provided by the changes in their external environment. There could be several sources responsible for these changes. However, this theory considers changes only in the regulatory environment and technological innovations. These two factors have been the major driver behind growth of the firms and making the firm's primary business obsolete. First is regulatory change. Deregulation had played significant roles in mergers. Industries subjected to deregulation in the recent years like telecommunications, healthcare, insurance, utilities, media, defense had been actively indulging in merger activities. Deregulation promotes mergers by eliminating the barriers and stimulating competition. One of the best illustrations of this can be found in case of the telecommunications industry in USA. Initially, competition was not allowed between the local and long distance phone companies. Cable companies had monopoly in the market. However, with the enforcement of the Telecommunications Act of 1996, both local and long distance phone companies were allowed to compete with each other markets, and the cable companies were allowed to offer both internet and local telephone services. The Financial Services Modernization Act of 1999, which replaced the earlier legislation, which dates back to the Great Depression, enabled commercial banks to merge with securities firms and insurance companies, diversifying their activities restricted earlier to just accepting deposits and granting loans. Second is technological change. Technological change promotes and creates newer products and industries. For example, advancement of the digital camera technology brought about dramatic reduction in the demand for analog cameras and film, forcing the major players in this field like Kodak and Polaroid to re-strategize and adapt to these changes. With the expansion of broadband technology, Internet has come a long way with convergence of voice, data, and video technologies. It has been observed that smaller firms are capable of bringing about technological changes and innovation at a much faster rate as compared to the larger firms. With shortage in talent pool and shortening of product life cycle, larger firms neither have luxury of time nor resources for innovation. Under such situation, they look for mergers as it provides fast and often less expensive means of acquiring new technologies and technical know-how to overcome the shortcomings in their current line of products. They also use such mergers as strategy to prevent the new and important technologies from slipping into the hands of their competitors. Moving on to hubris, that is managerial pride and the winner's curse. Sometimes managers becomes overconfident of their decision taking abilities and believes that their own valuation of the target firm is superior to market valuation. Under such situation, the firm ends up overpaying the target because of being optimistic in evaluating synergies. Even the competition among the bidders results in winner overpaying due to hubris, that is arrogance of the managers, irrespective of the presence of synergies. During the bidding, range of bids for the target company tends to be very wide as the self-importance and arrogance of the senior managers make them very competitive. Just to satisfy their desire of not losing the bid results in the target company receiving the purchase price, which is much in excess to the actual economic value. The winner pays more than the company is worth and regret later. Hence, it is known as winner's curse. Next is buying undervalued assets, that is the Q ratio. The ratio of the market value of the stocks of the acquiring firm to the replacement cost of its assets is known as the Q ratio. Firms willing to expand does so either by investing in new plants and equipments or obtain the assets by acquiring a company whose market value is less than the investment required to replace the assets, that is, whose Q ratio is less than 1. The theory has been used to successfully explain the mergers in the 1970s. High inflation and interest rate resulted in stock prices falling down even below the book value of many firms. Book value is the assets value mentioned in the balance sheet and represents the cost at the time of acquiring it and not the current value. High inflation also resulted in replacement values higher than the book values. The example illustrating this theory is the merger of gasoline refiner Valero Energy Corporation and Premcure Inc. in 2005. The merger, which involved $8 billion transaction, resulted in the formation of the largest refiner in America. Valero benefited from this transaction as building a new refinery of equivalent capacity would have cost an estimated 40% more for Valero. Another is mismanagement or agency problem. Differences in the interests of the incumbent managers and the shareholders give rise to the agency problem. The problem arises when the management owns small fraction of the shares of the firms. In such cases, managers act as an agent of the shareholders. These managers may be more in favor of their own job security and lifestyle, neglecting the interests of the shareholders. The responsibility of maximizing the shareholders' value also might get totally neglected. Cost of such mismanagement may impact on the large number of shareholders, each owning only a small portion of the shares. This enables them to tolerate impacts of mismanagement for a longer period. Mergers often take place to correct the difference between the managers and the shareholders. Stimulated by the low stock prices, managers either take action to raise the stock price or become target for the acquirer. In case of the latter, the management of the acquiring firm considers the stock to be undervalued, at the same time are often tempted to remove the management of the target company because of their inefficiency. Agency problem further gets aggravated when the management initiates buyouts, particularly in case there are differences between the managers and the shareholders over the usage of excess cash flow. Managers have greater advantage of having access to such information which may not be readily available to the shareholders, which enables them to convince the lenders to provide fund to buy out shareholders so that ownership get concentrated in hands of the management. Further, managerialism. The managerialism theory for acquisition believes that managers go for acquisitions for selfish reasons, such as to satisfy their ego, add to their prestige, enhance their influence, and augment their compensation or self preservation. However, the theory ignores the intense pressure on the managers of the larger firms to sustain growth in the earnings in order to support the firm's share price. The increase in market value compels the managers to make large investments so as to sustain increase in shareholder value. Usually, smaller acquisitions do not have sufficient impact on earnings and may destroy the value. Still, managers go for it mainly to support shareholders' interest, foregoing their own interest of preserving management autonomy. Next is tax considerations. Firms that combine through mergers offset their taxable income by gaining from tax benefit like loss carry forwards and investment tax credits. Acquirers with losses may use them to offset future profits and also use the unused tax credits held by the target company to lower future tax liabilities. Acquiring firm may benefit from additional tax saving as purchase accounting method requires book value of the assets to be devalued according to the current market value. The resulting depreciation is deducted from the revenue in calculating the future taxable income of the combined firm. Often the taxable nature of the transaction plays a more crucial role in determining merger than the tax benefits that the acquirer may enjoy post-merger. Tax-free transaction is viewed by the seller or target as prerequisite for the merger to take place. A properly designed transaction allows the target shareholders to defer any gain from the transaction until the acquirer's stock received in exchange for their share is actually sold. In case the transaction is not tax-free, seller would demand higher purchase price as a compensation for the tax liability resulting from the transaction. Misvaluation. It is presumed that if the markets are efficient, share price of the target accurately reflects the true economic value and all other information regarding the firm. However, in the absence of such information, investors may either over or undervalue the firm. There is difference of opinion considering the asset values over time reflecting the true economic value as they may not do so on specific times. Some assume that the acquirers can gain periodically by buying undervalued target for a price less than their actual value or by using equity as long as the overvaluation of the target is less than the bidding firm's stock. Overvalued share allows the acquirer to purchase a target by issuing fewer shares in case of share for share exchange with the target. This prevents the diluting of the ownership position of the acquirer firm's shareholders in the combined firm. The dilution is representative of a significant cost to the current shareholders of the acquirer. The proportionate ownership position of current shareholders is reduced each time a firm increases its shares outstanding. This cost is reduced by overvalued shares. Last is market power. The theory of market power view improving the monopoly power as the main motive behind mergers. Firms tend to improve their monopoly power through mergers in order to set the product prices at levels which may not be sustainable in a more competitive market. However, the theory lacks proper evidence, although it is often cited as one of the motives for merger. However, there are several evidences supporting the view that increased merger activity enhances the operational efficiency of the firm rather than increasing its market power. Now, we will focus on the determinants of success and failure of mergers. The main intention of merger is to improve the performance of the combining firm. It is believed that when a merger takes place, the combined firm will be greater than the sum of the two firms. The most common criteria which are used to measure the success or the failure of merger are the profitability of the combined firm, which is expected to increase in absolute terms or when measured to the capital employed. The other criteria include efficiency gains determined by cost reduction or increase in productivity, returns to shareholders indicated by share prices, benefits to stakeholders like increased employment, and the benefits to the management, which is a strong indicator of the achievement of corporate objectives. However, it is difficult to differentiate between the impact of merger and impacts of the other factors on performance of the firm. In case mergers take place at the beginning of the business cycle, then the success or the failure can be partly attributed to the merger, while the subsequent performance cannot be attributed to mergers alone. If the company is engaged in multiple mergers, it becomes even more difficult to measure the effect of each measure.
Let us summarize the discussion we have done so far. Merger is one of the major strategies used by the firms to grow and increase profitability. Mergers are mainly of two types: horizontal, vertical, and conglomerate. The motivation for mergers arises from several strategic and economic reasons, which can be explained by different theories put forward. The prominent theories include efficiency through synergies, diversification, strategic realignment, managerial problems, tax consideration, misevaluations, etc. Empirical evidence mostly favor the view that merger is not so profitable and is a highly risky strategy which more often turns out to be unsuccessful.